The number one thing when it comes to, cap rates is investors' confidence in future cash flows. So what that says is, well, the market expects rents to keep going up. That's it, right? That's pretty much in a nutshell.
That's
And
right.
right, and
That's
that's
absolutely go right. Yeah.
and if you want to do any comparisons to 2007, again, that's why, prices were so high and cap rates and risk spreads were so low back in 2007,
Mm.
because the assumption was that, rents are going to go up. And then we hit a recession and rents were negative to flat for years in most property categories.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this podcast and YouTube series, Real Estate Market Watch, current events through a real estate lens. My guest today is Paul Fiorilla, who is Director of US Research at Yardi Matrix. Paul and I have become good friends over the last few years. He is a regular guest on the podcast, and he covers most of the major asset classes in his work, in his analyses, and in his work over there at Yardi Matrix. In fact, we're gonna kind of focus today on the latest multifamily report that he just put out. But I'm going to read something from the bottom of it here. It says, Yardi Matrix Multifamily provides accurate data on nearly 23 million units, covering over 92% of the US population. Paul has a view into the industry like nobody else. Our conversation today covers some of the findings of that report, but we also dive into what drives the data and how the data is analyzed and how those analyses are evolving as the geopolitical and macroeconomic world changes around us. Very interesting discussion, and it will be coming up just in a moment. But before we start, do please remember to go to GowerCrowd.com, hit the subscribe button. I do provide a fairly detailed summary and analysis of my conversations on these podcasts, including with Paul today, in my newsletter. So go ahead and subscribe there. You'll see the names of some of the companies that subscribers to the newsletter work for. It's quite an interesting list. You'll be in good company. So go ahead and subscribe. GowerCrowd.com, hit the subscribe button. You can always unsubscribe. Comes out, once or twice a week, depending on how often I record podcasts. Okay, let's turn it over now to Paul Fiorilla, Director of US Research at Yardi Matrix. Here he is. Paul, it's super nice to see you. As I mentioned before we started, it was a pleasure to meet you IRL as well. One of the few people I've had the pleasure of meeting in person. All right, so
You're
you're
like the character in Groundhog Day. Remember when Bill Murray was going around and the old ladies were in the car and their car died. Yeah, I think it was a flat tire and he ran out there and jacked it up.
pumped it up.
Just for people who are, watching, don't know what I'm talking about. I'm from New Jersey. I was 3,000 miles away from home in California, and my car battery died, and the rental car we had, and Adam was right there with a to jump the car. It was kind of funny, but yeah, it was fun to
Goodness.
meet.
Well, I'm glad to say that we only lived through that once, Paul. We don't need to live through it again a few hundred times before we get it right. You'll know not to rent an electric car next time. That's the thing, right?
Not that
Uh,
one. Yeah.
all right, so you sent me some of your latest research. Thank you so much for doing that. But let's start kind of a kind of a higher level. Now, you've been tracking how macro volatility in your research, like interest rates, inflation, and even tariff policy, has started to ripple through transaction volume and the lending environment. How are these factors showing up in your data now? And how do you think, the market is underestimating them, kind of some of these external factors that influence these usual drivers.
Yeah, I think a lot of these things are going to have long-term impacts on the market. Short-term, the
Mm,
impacts of economic policy take a little while to kind of bleed into the data. So if we're just looking at multifamily data, we're coming off, some really strong performance over the last year, few years. Last year in particular was also strong. And we had really strong multifamily demand. Rent growth has been largely a function of supply growth, but demand has been really strong, and that's led to a lot of optimism.
mm,
Um, and now, as we're coming into this year, we kind of the market was optimistic, and then Liberation Day hit, and then the market was pessimistic for a short time. But the data continues to show fairly strong. It's demand has weakened a little bit, but last year it's weakened off of really, really super high levels. And in the immediate impact of the tariffs, deal flow kind of ground to a halt. But then Trump backtracked a little bit on China, and the market has the sense that that the tariffs are more of a negotiating ploy than an actual increase in inflation. And I'm just saying that's kind of what the market seems to be viewing, right? Stock
mm,
market dropped like 15%, but now it's back up. It's still not back to where it was, but and the same thing with deal flow, like the CMBS market paused for a few weeks, but now it's kind of back. Investor demand is really strong, and deals that were just sitting on the sidelines are, have come back to market. So I think the market in general is once again optimistic about, the economy. And then, also as we're looking at things like the big beautiful bill, the budget that's being negotiated, it includes a lot of things that the industry has sought. It's maintained all of its tax breaks. It looks as though the regulatory things that have been an issue in the multifamily world, some of them are, most of them are probably going to be eased a little bit. There are some, even for example, on the affordable housing side, I was, at the Urban Land Institute's Affordable and Workforce Housing Council last week. And when they talked about the budget negotiations, there was kind of a sigh of relief because it wasn't as bad as it could have been. And in fact, things like the low-income housing tax credit is being expanded. Opportunity zone is probably going to be renewed at favorable levels. So there's good things. Now, there's also some bad things like, the potential cuts to or elimination of Section 8 and some of the home subsidy programs, which would be in the words of some of the people in the industry, catastrophic. But for the most part,
Wait. Let's just drill down on that. So
yeah.
in what way catastrophic? What are they saying? What does it mean? Catastrophic.
Well, let me just finish. I'll get to that in a second. But just
Sure.
so just generally speaking, there are positives. The economy doesn't seem to have slowed down, so I think the market has kind of regained a sense of optimism in the short term. But in the long term, the impacts were still really, again, months away, quarters away from, the impacts of some of the tariffs, the job cuts, the cuts to health, research and other, industries, federal contracts and all those things will show up. How much they'll show up and what exactly that'll mean, it's kind of uncertain at this point. But so yeah, we'll see. Now the Section 8 is a renter
Yeah.
subsidy, and the home or renter subsidy programs in which the federal government directly pays the rent of tenants. So if they stop doing that, even if they just, the one of the, and this isn't a done deal, but there were some suggestions that those might be the negotiations, that some of those programs might be turned over to the states as block grants, which would mean, that the certainty of those payments that property owners now have would dry up. So if there was any cut in those payments, then, that's just like eliminating, the income of multifamily properties that have tenants that are, that use those programs. So that would be catastrophic to the owners of, programs that rely on, those federal payments.
Paul, just kind of backtracking a little bit. So, you've taught, and this is a really important distinction actually, that the market appears to have short-term confidence. But we're in a long-term industry. This is an illiquid business that we're in. And do you think, and this goes back to my original question, do you think that the market is underestimating the potential impact of the long-term impact? And it just makes no sense to me that everybody's running around as ebullient as they are today, when guys like you and I are sitting here thinking, yeah, but long term, long term meaning what? Long term could be next year, for heaven's sake. You buy a deal, you're in it for years. So is the market underestimating what's really going on, the undercurrents in the market, do you think?
Yeah, I mean, look, everybody doesn't have the same opinion, and there's certainly a range of opinions within the industry. But I think that, so take multifamily, right? The narrative that we've heard a lot of in the last few months is right. So I mentioned before that the multifamily rent growth by metro depends to a large degree on supply growth.
Yeah.
So so over the last 15 months or so, the metros that have seen consistent rent growth, 3 to 5%, are in the Northeast and the Midwest, right? So we have a monthly publications where we track our top 30 metros, and the top 10 or so have been dominated almost completely by markets in the Northeast and the Midwest over the last, say 15 months or so. Meanwhile, the Sunbelt markets have had negative rent growth or flat rent growth. Markets like, Austin has been the worst. I think it's about -5% in advertised rents year over year. But other markets are down, 2, 3%, Denver, Atlanta, Nashville, those kind of markets where there's a huge amount of supply growth. And even though demand is strong, it's just not enough to match the increase in supply. And now as the multifamily starts have declined precipitously over the last, again, about 18 months or so, down about 40%, 24 to compared to 23. The supply pipeline is going to decline. So nationally this year we peaked, our deliveries peaked this year at, over 600,000 units, multifamily units nationally. And because starts are going down, deliveries are going to go down over the next few years.
Right.
And kind of the narrative is, oh, this is really good news because, as supply goes down, as deliveries get reduced, then those markets that have an abundance of supply causing rents to drop, that those markets are going to start seeing really solid rent growth again sometime maybe next year, and be really strong. And I mean, I agree completely with the general arc of that story, but I think we have to be cautious because, first of all, our data shows that, so the supply pipeline is not dropping off as quickly as it might seem, even though starts are down. there are already so many units under construction. So there's about 1.2 million units nationally that are either in lease up or under construction. So the markets that have the really heavy supply pressures still have a lot of properties under construction and in lease up. So the when we look at like the national number and say, oh, deliveries are going to drop by 40%, but they're not going to drop by that much in every market. So the markets that need more construction deliveries are going down in places like Chicago and Los Angeles and New York, which really need more supply, just as fast as they're going down in, markets that already are saturated in the short term. So if you look at markets like, Austin and Nashville and Salt Lake City and some of these markets where they've added like 6-7% of stock the last couple of years. Yeah, the growth in deliveries is going down, but not in half, right? So our forecast for a lot of these markets will have 12 to 15% of added to stock over the next 3 years, even more in a couple of markets. So the markets that need, to see deliveries drop the most, it might not happen as fast. And then, the other component to that is demand, right? So demand, we've come off several years of really strong demand, right? And there were over 700,000 multifamily units absorbed in 2021. We had a couple of strong years, and then last year it went up to about 600,000. So not quite peak levels, but really high by historical levels.
Mm.
And that was driven by, things like the strong job market, people who have income and are confident about their job and the economy. They form more households. People split up from roommates. People, young people would move from their parents and so on and so forth. Plus, there's been really high immigration levels. We had, 6 million immigrants come into the country these last 2 years, according to the federal government. Plus, work from home has, been kind of a factor in creating demand in, suburbs and in secondary and tertiary markets. And the home market, the weak home sales, the high cost of owning a home compared to rentals has kept a lot of people in multifamily. Now, the home price and the weak home sale market is probably going to continue, but some of those other factors, immigration obviously is going down. We were expecting the job market to cool because we had 4 years of which there were about 15 million jobs created over 4 years. And that was likely to weaken under any circumstances, even before, the federal government started, cutting people, and the federal government's not that big into the whole country. But then when you add into that, again, cutting grants and kind of the uncertainty that have caused a lot of companies to put their expansion plans on hold. So, the job market might not be as strong as it was going forward. So some of the drivers of demand, the risks, I would say, the way I would put it is the risks are to the downside, right? That, not that everything's going to fall off a cliff, but the strong growth we've had in demand, I would expect to cool a bit, when you add that up with, maybe the delivery pipeline doesn't slow as quickly as we hoped. The recovery in multifamily might take a little longer. It might not be as strong as people are expecting. And again, I'm not bearish on multifamily. I just think the exuberance about the future that we hear I think we need to be cautious and so as far as which markets and submarkets you're going into and to really examine the supply and demand metrics and wherever you happen to be investing.
Paul, are there any signals that, again, this goes back to my same question. Any signals that you think the market is missing? Let me contextualize my question a little bit differently. If we were sitting today, 2007 or mid 2008, before Lehman Brothers collapsed, right? We've got alt A's are going bad, subprime has already gone bad, alt A's are going bad. There's starting to feel like there's, stuff going on. And the market, on the other, you look at the headlines from that time, mid 2008, right before we did go off a cliff or almost went off a cliff, sounds very similar to the way that the headlines are today. And we would probably have the same kind of conversation that we're having today. But there's more going on, isn't there? I mean, it's we've got to elevate to 50,000 feet. What are we missing? I mean, are we missing something? It just look, my point is I think the market is just trundling along, eyes wide shut. That's my point. What do you think?
Well,
Seriously.
I
Strength of
I
the dollar,
I
confidence in
agree to
America.
some extent with what you're saying, but I think the risks would be I would put them in two categories. One would be exogenous events. Um, there's a lot of tension around the world, and something could set that off. Now that that could happen anytime, and that's not unique to today. Although I think there are heightened concerns, in the Middle East and Europe with Russia and, with our country and how we are approaching the world. But I think our foreign policy is a definite concern. But again, it's not a concern for the next 6 months. I think, long term, um, the fact that America's position in the world, uh, I think companies in other countries are, could be reordering their supply pipelines or chains and in a way to avoid the United States. And again, that's not like a quarterly problem. I just think that could be a long-term problem. I mean, I've heard, you know, well, for example, like Canada, right? So the people in Canada, I know people who say, we can't come to the US for conferences, tourism is down, investment between the countries is declining. And yeah, there's a lot of, the US has always been, I mean, one of the features of the US has always been, its position as the place where, the most stable government on the planet, and the
Mhm.
rule of law was really solid. And if we go too far in the other direction, yeah, that poses, in my opinion, it poses, definite risks down the road.
Are you
Um,
sensing any
but I also think, just to finish,
sure.
well, before, I don't think the market is in as precarious a position as it was in 2007, because there were some really, really aggressive, transactions, equity and debt transactions, that just didn't make any sense whatsoever, going back to the, '05 to '07 market. And I don't think the market has gotten anywhere nearly as aggressive this time around. And I've been saying this for several years because, when rates went up, that created kind of a situation with potential loan delinquencies. And I mean, I've been arguing for, well, I guess almost 3 years now, that I don't think that, that the market is in the same place it was, but just before the GFC. But I think, again, there's the risk of exogenous events. There's the risks of, in the medium to long term, that, policy and other types of things, um, you know, foreign, events and the like that could, you know, create
Right.
problems down the road. And
Right. So
it's
that's exactly my
and
point.
I can't right. Well, can I say, oh, it's going to happen, 3 months, 6 months, a year? I don't know exactly when, but yeah, I mean, I think that there are definite risks in that regard.
Right. In a different way than there have been before, this exposure to commercial real estate of political uncertainty. This is something that is unusual today. We didn't have that before. I mean, I can't remember any time in my lengthy career that we've seen anything like this. And it's that underestimation that I think is kind of a critical problem actually in the industry at the moment. Are you seeing any kind of sensitivity to geopolitical or macroeconomic or political uncertainty in the data? Like, are you able to extract, or is it all strictly the usual, metrics, suspects, right? The
I
metrics.
mean, I mean, the data is, the data, and then, trying to decide why the data is the way it is another thing. And
Mm,
again, all the changes in policies that we're experiencing are all pretty new, right? So, I mean, we haven't seen a whole lot of second quarter economic data, even, layoffs, because, they don't all happen at once. That takes a little time to filter into the employment. People could be, could be fired, but still, technically working for a couple months, or, things like that. So, yeah, it's a little bit hard. I mean, like obviously the thing that is, does bleed into that does show up in the data is, all the uncertainty indexes, which are, off the charts.
mm,
And, you know, again, businesses in times of uncertainty, tend to sit on their hands. And I think coming into this year, there was an expectation in our industry that, interest rates were going to go down, and, we were going to start to see a pickup. And, we've had a couple of years of slow transaction activity, and, that was going to pick up. But, uh, the worst thing that could happen for transaction activity is uncertainty. So, um, you know, I think I think optimism is reflected in the fact that there is just a lot of liquidity on the debt and the equity side, a lot of dry powder, a lot of lenders that would really, like to put out money. The difficulty is, how many sellers are going to want to sell right now, when, they're, there's a lot of uncertainty. And I think sellers, unless they have to sell, kind of hold off. We had a lot of loans that were, extended, and, the extensions are coming due, and that had led to a lot of predictions of distress. I think in large part that banks are dealing with, rollover, the loans that have finished their extension periods and need
right.
to be dealt with. I think, banks are dealing with them on a one-off basis, and, there aren't any large portfolio sales. But so it's not, there's not like an obvious sense of crisis that, oh wow, we've got this huge delinquency problem. But
We
yeah,
do have a maturity wall, though, don't we? There's a lot hitting the wall this year.
yeah, and that's kind of what I was referring to, right? So you've got not only loans that were, in their regular schedule to come due, but the loans that have been extended for the last couple of years. And so, there probably will be, an uptick of delinquencies for borrowers that just, can't keep, extending, or don't have the wherewithal to, continue to pay down balances, or do whatever, banks are asking. But at the same time, again, because there's so much capital that's looking to deal with these, to, provide, capital to buy these kind of situations. I think a lot of it's getting handled quietly and, kind of on a one-off basis. So it's not in the news so much. And that's again a sign that, there's uh, a lot of money, looking our asset class, particularly multifamily. There's just a lot of capital looking to invest.
Paul, you've been doing this a long time. I know, this kind of data analysis. Do you track so you've talked about supply and demand as, one of the key things that you look at. But have you ever looked at or track the correlation to interest rates and how that can stymie even supply demand equilibrium? Right, you've got strong to give a low supply, high demand, but high and rising interest rates or uncertainty with interest rates doesn't really change. That kind of, the word I want to use is neuters. It's the wrong word, but flattens the. What's the word I want to look for? It's a third dimension that really needs to be considered, because everything that we do in real estate is, can we afford to, build or to buy, etc. Will
Yeah,
people
no,
sell?
interest rates are a big thing, but I think, the bigger thing is like more than where absolute rates are is the change in rates. So if rates are changing all the time, then that makes it difficult for investors to deal with.
Plan. Right.
Where interest rates are now are historically not crazy, right? Because before the GFC, we would be in, what would be considered a normal or even, slightly lower than normal interest rate environment. We had, a decade or more of really low interest rates, and that's probably more outside the norm than where we are now. The problem, that we've had is that we had a sharp increase in rates in 2022, right? If rates had kind of gradually, gone from where they were and moved up to here, the market would have been able to absorb that a lot better than just like going from 0 to 4, right? Which is kind of what we did in over the course of a year. So that's what's created, the refinancing issues because, you have a 3% mortgage and now you're refinancing at 6% or something like that. That's what creates the kind of distress and kind of the things that borrowers and banks are dealing with. Um, and like loan, still even to this day, right? In multifamily, deals are getting done at not either at negative leverage or at a
Right.
spread that's not well below historical uh, risk spreads, right? So maybe the long term, you
What
know,
does that tell you? What does that tell you? This is what reinforces the
yeah,
thought that I have, that people are just not acting rationally. They're
right.
not looking at the big picture. They're just anxious to stay busy.
Well, the number one thing when it comes to cap rates is investors' confidence in future cash flows. So what that says is, well, the market expects rents to keep going up. That's it, right? That's pretty much in a nutshell.
That's
And
right.
right, and
That's how
that's
it go right. Yeah.
and if you want to do any comparisons to 2007, again, that's why, prices were so high and cap rates and risk spreads were so low back in 2007,
Mm.
because the assumption was that, rents are going to go up. And then we hit a recession and rents were negative to flat for years in most property categories. So if you're looking for something that is a little bit worrying, it's that, we're at, um, the brink of a new kind of economic climate, and people, investors in the industry are still paying, relatively high prices, relative to their costs, to the cost of debt. Um, is that's a potential? Yeah, that's definitely a potential thing because then, when you're when you're making aggressive assumptions, you are closer to the edge if something bad happens. And then that's again getting into what I was saying before about like an exogenous shock or, a downturn in the economy. The closer you are to the edge, then, the worse that could be. But not to, and that sounds really negative, but again, I don't think the market is anywhere near as aggressive now, generally speaking, in the way it's approached transactions and lending as it was in '05 and '07. And I was in the middle of that market back then, kind of saw all the gory details. And
Yeah.
in my opinion, we've gotten a little bit of aggressive, more aggressive in recent years because, things have been good. Most property types have performed well, but, we're not as quite as aggressive. And so I think unless things really go south in the economy and the world, I don't think we're quite in the position we were to lead to like a big, meltdown. But yeah, no, I definitely think though that um, people, in the industry, investors need to be careful and not just kind of shrug off the risks that are in what I think are in the medium to long term.
Let's wrap up with three questions. Actually, it's a good segue into my rapid fire sign off questions, three of them. So, what are the signals that you personally watch that will give you early warning of any shifts in the industry? What are you watching?
Well, I think on
Right.
multifamily, yeah, the big things will be demand, absorption, and occupancy rates. So, we've maintained, despite the high levels of new supply, we've maintained fairly strong occupancy rates. The national occupancy rate of stabilized properties, according to Yardi Matrix, is about 94.5%, somewhere around there. That's pretty good by historical standards. And even in the high supply markets, which have seen occupancy rates decline over the last year or so, over the last couple of years, they're still not in terrible shape. So if we start to see that weaken even further, that would be a worrying thing. And I think if another thing would be, the job market, that would be if job growth turns negative, that would be a big thing. And if we start to see, the deal flow slip, again, that's a sign of investor confidence going down.
Okay, I said three questions, but you preemptively answered my third one. So here's my last
Okay.
question. Thank you so much for doing that. I need to revamp these anyway. Right, so my last question. This is a question about cash, being in cash. If you were to win $1 million on the lottery today, what would you do with it?
Oh, today? Um, how do you know I haven't? No,
You probably wouldn't be
I,
talking to me, I would guess.
I,
Or
you
you'd
know,
be on a beach
I,
somewhere talking to me instead.
I would, I'd give it to my wife and she would decide what to do with it. She handles all that stuff.
That is
Uh,
brilliant, actually. I tell, let me just let me before we go on, all right, Steve. Let me tell you a very brief story. I met a guy 100 years ago. I was in Cornwall, or actually in France, and there was this fellow there. And we met this old fella, and he was on holiday on his own. This is a long time ago. I was with my girlfriend, and he was there on his own. And he said, "Yeah, my wife, she's not well. Normally, I go on holiday with her." And so this was his story. He worked in the Coast Guard, and he said that he literally was paid every week. He would go in they would give him his weekly paycheck in cash in a cup. He'd go into the boss's office and the fella would turn it upside down. He'd pick it up, count it, go home and give it to his wife. That's what he always did. And she did everything else. He did nothing. He knew nothing about the household budget, where they went on it. She did everything. So it's a lovely story to hear you say that. It gives me flashback to that.
Yeah.
But actually,
He already pays me in shells, so I'm just kidding. Yeah.
So anyway, seriously, so what I'm getting at is, would you keep it in cash? Would you rush out and buy a multifamily big building? Would you invest in some syndications? Would you buy gold? Like what would you do with $1 million in cash if your wife gave you permission to do whatever you wanted?
Yeah, I mean, look, have to like balance my portfolio. As a real estate investor, I'd say, well, what would I invest in as opposed to like personally? I mean, personally, I'm a fairly conservative investor, and I'm getting close to retirement age. So I don't know. I probably wouldn't do it too risky with it, but and but if I was investing, multifamily, I think there would be. There's a lot of, strong markets to invest in. I think multifamily is, generally speaking, a very solid investment, and you'd have to find, a good, well-capitalized, kind of fund to invest with.
So I'm not asking for investment advice. You wouldn't sit on it for a year or, wait like a lot of people are. Buffett has gone to cash. I mean, for heaven's sake, whatever it's some huge numbers. Just sitting and waiting patiently.
Yeah, I don't know. I mean, again,
You
I don't know. Probably put it in something. I mean, like right now, you can earn interest on on funds, but I'm not.
All right. Anyway,
I'm just not like comfortable with like giving investment advice, I guess.
I know. It's not investment advice.
It's not my thing,
Paul Fiorilla, what you'll think is director of US research at Yardi Matrix and a super nice guy, good friend. Thank you so much for joining me on the podcast today.
Thanks, Adam. It's good to see you virtually.
Right, that was Paul Fiorilla, director of US research at Yardi Matrix. Paul, what a pleasure to see you again. Oh my goodness, it was such a delight meeting you in person. I'm sorry it was a bit of a kerfuffle that day we met. I would love to have just kind of hung out and relaxed. And those kites were really cool as well. I've lived here for over 10 years. I've never seen those, so I'll have to keep an eye out for those again in the future. All right, but of course, thanks for joining me today and for your insights and for sharing with me your reports. So I had a chance to read those and for talking about them today. Really appreciate it. And thank you to dear viewers for joining us today. I will try to include at least the multifamily report on the show notes page that you'll find at gowercrowd.com, so you can take a look at that. And while you're there, of course, do please subscribe to the newsletter where I will be producing and distributing a summary of today's conversation and of all the conversations that I have on this podcast series, right? So I'm writing some detailed summaries so that you can both listen, or three ways of consuming these podcasts: listen to them, watch them, or read the summaries, right? So all there at gowercrowd.com, hit the subscribe button. Okay, that's all I have for this week. Thank you for joining me, and until next time, this is Adam Gower signing off.